Chapter 2, Raamdeo Agrawal. This is a masterclass with super investors. We are now going to learn some of the key insights from the chairman of Motilal Oswal, Mr. Raamdeo Agrawal. A lot of things to learn from him. The biggest one is QGLP framework that he shared, inspired by his readings and learnings from Warren Buffett, where QGLP is quality business. Look for companies which have a quality business, meaning the business has some sort of tailwind and it's good business. The business with good quality management. So that's the Q. Good quality business and quality management. Second is the business that grows. I think this is he emphasizes growth much more than Warren Buffett, is what he says himself. So he looks for really high growth companies, and we'll find out later that he likes those that double in 3 years revenue at the minimum. And so he likes to go for high growth companies, and longevity of growth is the third pillar, and at a reasonable price. You don't pay too much, you buy it at a reasonable price. So that's the QGLP framework that Raamdeo Agrawal shares. That is his key framework that he uses for all of his investments that his managers in Motilal Oswal currently follow. So his journey is pretty interesting. So let's see what his journey was like. So very big family, 6 brothers, 2 sisters. He claims that he was relatively very rich when he grew up in the village near Raipur, studied in Hindi. But the key thing that helped him was his family had huge emphasis in education, and they made sure that he studied, especially a big role of his mother. Reading this chapter, that his mother somehow always envisioned him to be a chartered accountant. He had no idea what a chartered accountant is, and long behold, he actually becomes a CA after doing his BCom. So goes from Raipur and then eventually lands in Mumbai, right? Tries applying for, it took 5 years to clear his chartered accountancy. Applied almost 150 places, got rejection from everywhere. And but he loved reading balance sheets, so he would scoop up as many balance sheets that he could from anywhere he could find. So he analyzed balance sheet, and his brother was the source of savings. He was in merchant navy, and they had 30,000 a month of income that he could invest in. A lot of it he could invest in. So he started investing his brother's money, and doing equity research was the next big thing for him. So he didn't like CA at all, is what he claims. And then at some point where he was living in Mumbai, Lokhandwala area, he found this neighbor of his called Motilal, and both of them actually had interest in stock market. Motilal had 2 other brothers, one in Ahmedabad and one in Chennai, and they were looking for a broker and who would trade in Mumbai. So both of those other brothers were buying those shares in other stock exchanges, and they had recently been cheated by someone in Mumbai, so they were looking for someone. So Motilal and Raamdeo, they partnered to build a partnership, and they become a sub broker and start earning brokerage. So the 10 lakh that they invested from brothers saving, eventually that took them 4 years to get to that investments. But then in 2 years, that becomes 30 crores. So that's the biggest jump. The 1992 bull run is where they made a lot of initial money. And every brokerage that came every day, they used to just put that money in and use the equity research background that Mr. Raamdeo had, and invested and kept buying stocks. So 10 lakhs to 30 crores. And then there was a crash too in 1992. So 30 crores becomes 10 crores. But again, 10 lakhs becoming 10 crores, right? It's 100x. So that's a huge, huge jump. So that was his first leg up in terms of how he made the money. Then that same thing went from 10 crores to 100 crores in 2001. So over the next 8 years, that became 100 crores. And then in 2003 crash, 9/11 and others, 100 crores became 30 crores. But then eventually that 30 crores went to 500 crores in the great credit boom in 2007. And 2013, he says 700 crores. 500 became 700 crores. So it's a huge journey, but if you think about it, it's a 30-year investment cycle, and he's more than 10x in 10 years, right? So he's done much more. But the key insight of this journey is, if you look at it overall, he has consistently stayed in the market, and he had a vision. He put money in the stock market and then kept consistently compounding. So that's the key learning from this: consistent compounding with great quality companies. So what sort of companies did he buy? The big wins that he had were in Hero Motors initially, Bharti Airtel, Birla Corp, United Spirits, HPCL, and so many that are listed in the book. But a key thing to learn that he was able to quickly classify companies in the 3 G's: great, good, and gruesome. Great are those companies which have high return on capital employed and are able to redeploy more and more capital at higher and higher rates of return. And good companies just have the high return on capital. And gruesome are the ones that give you return less than the cost of capital. So he's able to quickly identify companies and was able to put money into these companies and stay patient. So that's what the insights that he shares with us is having the vision to see if you can at least at the minimum see a revenue growth of 25% every year, meaning doubling in 3 years. If only then he invests, and he says that's a good strategy for what he used. And so that means in 10x, in 10 years, it'll become 10x. In 20 years, it becomes 100x. So if you start with 1 lakh, that becomes 1 crore, 10 lakhs in 10 years, but it becomes 1 crore in 20 years. And that same thing becomes 10 crores in 30 years, right? So that's a huge compounding effect. And you only do that via companies that have huge tailwinds. That's what he's looking for. He's looking for companies which have a lot of tailwind behind them, meaning they're going to become really big. Group Finance was another investment that he talked about. And he advises to average up, which was a really good one. To say, hey, focus on 15 to 20 companies that you invest in, which have a tailwind. Business is good, management is good, long growth potential. Then keep averaging up in some of those focused companies. Value Migration was a new book that I found that he referenced, which I'll check out. But he reads a lot. That's another key insight. He reads 15 to 20 books every year. And Warren Buffett is his biggest role model. He's also called the Warren Buffett of India in some sense. Maybe Rakesh Jhunjhunwala would be a closest match. But he does a lot what Warren Buffett does, and is inspired by him. He's also inspired by Michael Porter's 5 Forces, which is what I found really interesting reference to the competitive structure analysis. So he's built a lot of these frameworks in his mind. Value migration, like from scooters, he saw the value migrating to motorcycles because of very clear advantage that the motorcycles had in terms of mileage that the motorcycles gave, much doubled, right? So he saw those value migration, he's able to see and apply these mental models that he has built around like monopolistic structure. Like he can see which companies have a monopoly and who can actually build that large leading share, can employ network effects, and can understand what the supply side dynamics, demand side dynamics is, and he can forecast these things, which is pretty interesting. He's actually using a series of this mental models to find out which companies to bet on, right? And in the end, he ends with these few things which are really interesting. He says, be positive. For you to make money in the stock market, you have to stay positive with the right value system and right behavior. If you're not, if a lot of people with even lower IQs can make a lot of money if they behave well in financial markets, are positive for the long run, have a vision as to which companies are doing well, having a vision, but then courage to invest, and then patience to hold. Those are the three things that he says are really important. A lot of people might not even have the vision. So we need to first find out where are those tailwinds, which companies are growing, which countries are growing. He says that even the best fishermen can't fish if there is no fish in that area. So there's no growth. If the country is not growing, the companies are not growing, the industry is not growing, then it's immaterial. If you have good skills, you're not going to make money. So that was the biggest insight I took from unique from him, which was look for tailwinds and have that vision clear, and then have the courage. Like every investment brokerage dollar, that every investment brokerage rupee that he got, he invested like same day. And then he had the patience, 30 years, right? He's investing and compounding for a long time. And after a certain point, like if you imagine his 10 lakh became 30 crores and then 10 crores, but 10 to 10, even if it reduced 3x from 30 crores to 10 crores, he still made a lot of money. So there's nothing to lose. And his values around not leveraging money really helped him, because then he could sleep well. He could invest and not have to worry about leverage and eating, going down below what he's invested, right? So he says, find your true style. He says there are a million ways of making money. You don't have to use all of them. Find out which one works for you. Find out the tailwinds. And he ends with 2 rules of investing. Rule number one is don't lose money, meaning don't invest in speculative behavior. He doesn't leverage. Those are really good rules. And then second, he says, don't forget rule number 1, right? And I think one of this is, I think, borrowed from Warren Buffett or Charlie Munger, but this is a really interesting one, right? And he ardently follows them. Look at what Berkshire Hathaway has done. They have published reports from 1977 to 2020, and he started that too. Look at that. Motilal Oswal started doing that too, and he is now 25 years that he has been publishing some of these reports as well. So really interesting of how he is inspired by Warren Buffett, and he's actually scaling this up. So a lot of things to learn from Mr. Motilal. Mr. Motilal is not his name. His name is Raamdeo Agrawal, but he partnered with Mr. Motilal, and he's a chairman today of Motilal Oswal. So Raamdeo Agrawal, lots of interesting wins and learnings from him. The biggest one, look for tailwinds. Fish where there is fish, right? If it doesn't matter if you're a good fisherman and if you're fishing in an area that doesn't have a fish, right? Thanks.